We try to manage risk in every aspect of our lives. For example, we buy a car with airbags to prevent injuries during accidents. We eat healthy and exercise to avoid illnesses, and we use big locks and safety doors to secure our house. But managing risk is the last thing on our mind when it comes to investments. We take excessive risk hoping to make big returns, and most of us end up disappointed. Hello and welcome to Eating Money's YouTube channel. In today's video, we will discuss how to use asset allocation to reduce risk in your investments without compromising returns. Now, like all other videos, we have analyzed a lot of data to demonstrate asset allocation is necessary for every investor. So make sure you watch it till the end. There was a professor named Markowitz. He spent his life researching how you and I can make the best returns taking the least possible risk. His work led to the modern portfolio theory, for which he won the Nobel Prize. Now, Markowitz famously said that asset allocation is the only free lunch in investing. Now, what does that mean? Well, it means that you can earn higher returns with lower risk by diversifying across assets. Now, this is not just a theoretical statement. Simple maths can show that higher returns are possible with lower risk. Let's say you have a portfolio where 60 is invested in an equity index fund and 40 in a debt fund. At the same time, your friend starts with a 100% investment in an equity index fund. In the first year, the equities give you 12% return and the debt fund gains 7%. So, by the end of the year, your total investments will be 110. On the other hand, your friend ends up with 112 rupees. Your friend does better than you in the first year. Now, in the second year, let's say market fall by 30%. Your total portfolio will be worth 93. Your friend's portfolio will be 78. Your returns are higher because of the debt investment. While you lose money on 60% of your portfolio, the debt component still gives you 7%. Your friend, on the other hand, didn't have a debt fund protecting his investments. Now, in the real world, most people stop investing when they witness such a steep correction. Imagine you have a 50 lakh all equity portfolio and you lose over 15 lakhs within a few days. That's devastating. We saw this happen in 2020 during the COVID-19 pandemic and in 2008 after the global financial crisis. Asset allocation not only helps to protect your portfolio from shocks, but also encourages you to remain invested for the long term. Anyway, let's see what happens next year. By the end of the third year, the index fund goes up 12% again. Your total portfolio will be now 102 rupees and your friend's portfolio will be 88. By the end of the year 3, you are still ahead. Despite investing in debt, which gives lower returns than equities, you end up doing better. This difference is what Markowitz described as the free lunch. Now, one important point to note here. We deliberately took a short period of 3 years. This example helps to highlight the benefit of asset allocation. Usually, a 100% equity portfolio has better returns over the long term, but you get those returns with far higher risk. Now, we've been discussing risk since the start of the video. But what is risk in investing? One way to look at risk are the ups and downs in the market, which is also called as volatility. Another way to look at the risk is the uncertainty of returns. You may have heard many times that you will make decent returns in the markets if you stay invested for the long term. While this is true, no one can predict the returns you will make. Investing in a 100% equity portfolio, even for the long term, can be disappointing or even disastrous. Let me show you the risk of investing 100% in equities with some actual data. Let's say you started an SIP of 1000 in BSE Sensex on 1st January 1994. You wouldn't have made money for the 7, 8 or 9 years. Now, during those years, debt instruments were giving double-digit returns. The interest on PPF, for example, were 11 to 12%. The yields on government securities were in the same range. Now, imagine the frustration an investor would have experienced if long-term SIP returns were negative while simple debt products offered double-digit returns. That's not all. When the investor reached the 14th year, the returns were mouth-watering 20%. But in the 15th year, the investor again ended up with single-digit returns. That's the risk in equities. Even if you save for the long term, you don't know whether you will have single-digit or double-digit returns. But with asset allocation, an investor wouldn't end up with negative returns on his investment in the late 90s and early 2000. However, that's only half the story. The real magic happens when you rebalance the portfolio. Let's look at that in the next section. Now there are many ways to rebalance the portfolio. However, let's continue with our first example. You started with a portfolio allocation of 60-40. If you rebalance the portfolio every year and realign to the original asset allocation of 60-40, you will have much higher returns. Let's understand why your returns are higher. When you rebalance the portfolio, you book profits in the asset class that has done well and invest in the one with lower returns. When equity did well, the money flowed into debt. When markets corrected, the money went from debt to equity. Isn't this magic? You just rebalance the portfolio and earn even higher returns while lowering the risk further. Now, some of you could be thinking about tax. After all, when you sell your investments to rebalance, you pay tax. Now, in India, equity attracts lower taxes than other assets like debt and gold. So if your portfolio has debt, you will pay higher taxes. Now, if you invest in different assets and rebalance them regularly, your post-tax returns may be lower than a 100% equity portfolio. However, the benefit of asset allocation outweighs higher taxation. So don't let taxation alone be the deal breaker. Now, let's look at some real numbers in the next section. We did a study based on about 20 years of data. In this, we compared the performance of 3 different portfolios. The first portfolio has 100% equities, the second one starts with 80% equities and 20% debt, but it's not rebalanced. The third one is also an 80-20 portfolio, but it's rebalanced once a year. But before we tell you the results, there are 2 points you must note. We assumed an investor started the journey 233 months ago with a 20,000 rupee SIP. That's 7 months short of 20 years. In the third scenario, where the investor rebalances the portfolio, there will be a tax on selling investments. In this case, the investor stops the SIP and uses that money to pay the tax. This will help you see the impact of taxes. Now, let's talk about the results. In the 100% equity portfolio, the person invests 46.6 lakh over 233 months. He ends up with a portfolio of 2.43 crore rupees. If he liquidates the entire portfolio, he will need to pay 25 lakhs in taxes. In the 80-20 portfolio, where the investor doesn't rebalance, the end corpus is 1.92 crore. Here, the total amount invested is again 46.6 lakh. If he liquidates the entire portfolio, the tax liability will be 24.5 lakhs. Now, in the third scenario, where the investor rebalances the 80-20 portfolio, the end corpus is 2.2 crores. But the investment amount here is also lower as he used the SIP money to pay tax. So the total amount invested comes to 43.6 lakh. If he liquidates the final portfolio, he will end up paying 28.8 lakh in taxes. Now the tax is higher as there is 20% debt in the portfolio. The gains from debt are added to the investor's income. In our example, the tax rate is 30%. So the post-tax returns of the 100% equity portfolio comes to 14.07%. For 80-20 portfolio without rebalancing is 13.01%. In the portfolio where investor rebalances, the post-tax XIRR is 13.24%. Now this is just 83 basis points lower than the 100% equity portfolio. These returns are excellent considering there is 20% debt. And this portfolio is also less risky than 100% equities. Now you also have to consider one more point. In these examples, the investment starts in March 2005 and ends in August 2024. The equity markets have been in the strong bull run over the past 4 years since the COVID-19 pandemic. Despite this, the returns from the 100% equity portfolio are just 0.8 percentage points higher. Now, if we had done this exercise when the markets were sideways or had seen a correction, the results would have tilted in favor of the 80-20 portfolio, which is rebalanced every year. Now, think of the example we discussed earlier, when investors made zero returns for 7, 8 and 9 years between 1994 and 2003. This is another reason why an asset allocation approach is better than being 100% in equities. You invest for your financial goals and need money when the time comes. However, it's difficult to predict market conditions at that time. A systematic approach using asset allocation will ensure your gains are protected irrespective of market conditions. Although asset allocation is clearly the better approach to investing, most investors don't follow it. Most TV channels, YouTube videos, and other literature on investing focuses on one thing, choosing the right investment. And that's where most investors get stuck. They spend all their energy studying where to invest. This is the easier part. The tedious part starts once you have invested. You need to have a system in place to manage your investments. Even if you rebalance once a year, you need to spend some time reviewing your portfolio. You must check the variation in asset allocation and decide what to sell and what to buy. And you need to do it in a tax efficient manner. Now this gets tedious because investments are usually scattered. Many investors have more than 15-20 funds in their portfolios. They face decision paralysis with multiple funds. However, there's a better way to do this. Let's look at that in our next section. At ET Money, we have built a powerful investment management solution called ET Money Genius. It helps you choose the right investments, manages asset allocation and rebalancing, and strives to give you the best risk and tax-adjusted returns. First, it understands the level of market ups and downs that you can bear. For this, investors take our investor personality assessment, which gives them a risk range. Genius's ultimate SIP then uses this to suggest SIP plans best suited for your short, medium, and long-term investing horizons. You can choose index funds or stocks for your monthly investment in these plans based on your preference. Now, it also reduces the impact of tax while rebalancing your ultimate SIP plan in mutual funds each month. It does that in two ways. First, it avoids selling investments in the short term. For example, if you sell equities within 12 months, you must pay a 20% short-term capital gains tax. Now, Genius will avoid selling your mutual fund units until they complete 12 months to avoid this tax. The second way it saves tax is by harvesting them. To understand this, let's go back a few months. The July 2024 budget changed equity taxation. The long-term capital gain or LTCG is now 12.5% instead of 10% earlier. This applies when you sell stocks or mutual fund units after holding them for 12 months. The government has also hiked short-term tax on equities. If you sell equities within 12 months of investing, you now pay 20% tax instead of 15%. However, you pay the long-term tax only if your gains are more than 1.25 lakh in a financial year. Used smartly, this can translate into a tax saving of about 16,250 every year. Earlier, the exemption limit was 1 lakh and the benefit was 10,400. Let's take a simple example to understand this. Say you invested 5 lakh in equities in the financial year 24-25. After 1 year, your investments gain 20% or 1 lakh. Your total corpus is now 6 lakh rupees. If you sell this after a year, you pay zero tax. Reason, your gains are below the exemption limit of 1.25 lakh. Now, when you reinvest 6 lakh, it will be treated as a fresh investment for your tax purposes. You can repeat this process every year to book up to 1.25 lakh gains in equities. This is called tax gain harvesting. We have built this into Genius. With this, you can save up to 16,250 in taxes every year. Now, this is one of the ways Genius saves you tax. We have done more to ensure you get better tax-adjusted returns, and we will talk about them a bit later. Now, with Genius, you also don't need to worry about how much allocation you should have to equity, debt, and gold. Genius does that for you. You don't have to go through the tedious job of rebalancing. Genius takes care of it. Now, it doesn't maintain a static 60-40 or 70-30 equity debt portfolio. Genius follows dynamic asset allocation, which is more sophisticated. Let's take the example of an investor with a risk range of 64 to 86. He chooses to invest in this long-term ultimate SIP plan. This plan is built to have monthly recommended ideal equity allocation to be upwards of 80% on most occasions, with the flexibility to go up to 100% if markets are in deep discount. It can also allocate balance to debt and gold in a mix best deemed fit for market condition, with the aim to protect downside in expensive markets and hedge against equity risk in uncertain markets. Now, all this is decided based on data. Genius studies multiple data points such as market valuations, price trends, inflation, and interest rates. Based on this, Genius presents a monthly asset allocation to help you take advantage of the prevailing market trends. So if gold is doing well, you will have an allocation to it. If small caps drive the markets, Genius ensures you benefit from such trends. Genius can act with the needed caution or be rightfully opportunistic. Let me give you two examples to elaborate on what I mean. Let's first talk about gold. When returns from equity look highly uncertain, gold tends to do well. Genius analyzes price trends in gold and decides on allocation based on factors like geopolitical situations, liquidity, and inflation. In August 2024, When it was widely expected that the US Fed would cut interest rates, it made sense to allocate to gold as the dollar could weaken in such an event. So Genius increased the gold allocation during that month. That month also turned out to be one of the best for gold. The yellow metal prices rose by around 4%. Let's take another example of equities. Stock markets have been rallying for the past 2 years. However, they took a beating when the Ukraine-Russia war started at the end of February 2022. At that time, Genius decided a weakness in the markets and restricted the equity exposure to less than 50% for investors who opted for a long-term goal. Now that's how the dynamic rebalancing works in Genius, which optimizes your portfolio to make the best use of the prevailing market trends. However, before rebalancing, Genius will compare your existing allocation to the new one it's going to suggest. If the variation between the two is minute, Genius will not rebalance the portfolio. This reduces the sell transactions in your portfolio and lowers the tax impact. Genius never suggests selling units in the short term unless the risk is high. However, if it detects high risk, it will ignore the tax implications and focus on risk management. This will only happen on rare occasions. Over the long term, focusing on risk management is more beneficial than saving taxes. But these are just a few things Genius can do for you. There is much more to Genius, and you can truly understand and appreciate it once you experience it through a complete market cycle. So download the ET Money app and try it out. And with this, we have come to the end of this video. I hope you found this video useful, and if you did, please share it with your friends and family. I'll be back soon with another video. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Investments in security markets are subject to market risks. Read all the related documents carefully before investing.